these days. So I think we'll get started. For those of you I've not met, which may be quite a few of you, my name is James Comito. I am the National Director of Professional Standards at Mayer Hoffman McCann, kind of a fancy title. And I was scheduled to come out to Phoenix to do a presentation, and unfortunately, because of the pandemic, here we are, logged into Zoom, which is quite nice, by the way. Our firm has a different product, and I wish we had Zoom because, candidly, this seems to be a little bit easier to deal with. What we're going to do today is to talk a little bit about the pandemic and what it means for a financial reporting standpoint. There's actually quite a lot that's occurred, and you're probably like me, somewhat saturated from the whole ordeal. But nevertheless, I think there are some things here that I hope will be helpful to you. With that said, let's start the presentation. The agenda that I want to go through is actually broken into 3 sections. We're going to talk about financial reporting. We'll talk about some audit implications because I think it's going to be helpful for you to understand, those of you that have to get audited financial statements, some of the things that your audit firm is thinking about and things they may ask of you. And then finally, what's really happening here in 2020. If you actually think a little bit about it, the pandemic began somewhat in the very back end of 2019. And finally, I believe it was March 11th, 2020, the World Health Organization declared it a worldwide pandemic. And so that March 11th date is actually fairly important in so much that it puts sort of the stake in the ground in terms of the triggering event. And what that means is, when you look at your calendar year end, so your December 31st, 2019 financial statements, for the most part, the pandemic isn't going to force you to go out and make adjustments to your assets and liabilities. It will be what is known as a type 2 subsequent event. And so there'll be a lot of disclosure you'll have to make regarding the pandemic and what impact it may have had on your business, but is unlikely to cause you any actual adjustment to the financial statements. And I say unlikely because there is a scenario that I want to walk you through pertaining to debt that I think is a bit of a sleeper issue, and we'll get to that. So one of the things that comes up right out of the gate, and I wanted to put this first because it's sort of the worst case scenario, you start to think about going concern. Going concern is that process now that management is required to go through to evaluate whether the business is going to exist as an operating concern, a year from when the financial statements are actually issued. And so you have to decide whether or not that there's anything that gives rise to substantial doubt. And if there is some substantial doubt, again, about the ability to concern or to go forward as an operating entity, then do you have plans? Plans that would address the circumstances that give rise to substantial doubt. And so one of the things that we're seeing is if you've been in that situation before, if you've been a close call and you've had to deal with all of that stuff, certainly the pandemic adds to the concerns about future cash flows. If you're operating in an industry that's been shut down or partially shut down, and you know that there are going to be issues with respect to your future cash flows, you can see how this really plays into that evaluation. So one of the things that I've been advocating for quite some time is for management to actually spend the time and do a good, robust analysis of the going concern requirements. Remember, this was in the auditing standards for a lot of years, and I know on the private company side, a whole lot of folks weren't used to doing this particular analysis. But I've always told my clients it's a better story for you to tell than to rely on me as an auditor. And now, of course, it's in the accounting codification, so you're required to do it. Some things to consider. So as I mentioned, temporary or indefinite ceasing of operations, certainly that would be a factor. What about your revenue? Is it staying steady? Are you holding your own? Or, are you starting to see a decrease in revenue, maybe a decrease in backlog? What about your ability to get the resources necessary to run your business? Financing has become an issue for a lot of companies. And then something we'll spend more time on, what about compliance with your debt or other contractual covenants? If because of the pandemic, you may come out of compliance with your covenants, then certainly that's a factor that weighs heavily on the going concern. We'll talk a little bit about asset valuation, impairment. Again, employees, that's become naturally a very hot button here. Your accessibility, are you at risk now for losing part of your workforce? This list is certainly not meant to be all encompassing, but there's a lot of things to think about as we move forward. I want to talk about debt as it relates to this going concern. And in order to do that, I want to bring everybody up to speed as to what is typically happening, and then maybe give you a few examples as to how this pandemic, might impact you. Generally speaking, we know that, if you have a covenant violation at the balance sheet date, then normally that will result in the debt becoming callable. And obviously, if it's callable, then there's that reclassification from non-current to current. All right, I think all of us can wrap our minds around that. Now, sometimes there's a situation where after the balance sheet date, but before the issuance of the financial statements, okay, maybe you break a covenant. Let's say, for example, your calendar year end 2019, you get into March and you realize now that, again, partially because of the pandemic, you anticipate that you will be in violation before the financial statements are issued at the end of 120 days, okay, end of April. And so in practice, that's usually held to be the equivalent as if you were in default at year end. All right, so again, even though it happened after the balance sheet date, if it happens before the financial statements are issued, we look at those items as one and the same, and there's a good possibility that you're going to have to reclass your long-term debt to short-term. However, there are a couple of things that the literature allows for. Right? One might be to get a waiver. So that's about halfway through the first blue bullet point. It alludes to the fact that maybe your creditor will waive the covenant, or for some reason, maybe they'll lose the right to demand repayment for more than a year from the balance sheet date. Could be that you have a contractual grace period within the agreement. So yes, you're in violation of the covenant, but you're allowed a certain amount of time to cure that violation. And as long as it's probable that you'll cure that violation within that period, the debt won't become callable. So it could be that you use either of those two to sustain your long-term classification. And all of this, I think, is fairly straightforward, and it's the way it's been for quite some time. I'm going to talk a little bit now about the scenario that worries me the most. And it's if you have a covenant violation that hasn't occurred at the balance sheet, that hasn't occurred either at the point in time you're ready to issue your financial statements, but you suspect that there could be a violation within the next year. So again, I'll tell my story a little differently. Let's say we are sitting out now in April, 120-day requirement to provide your lender the financial statements, and things are not going well for the business. And you suspect when you pencil out your cash flows and all of the other ratios that are part of the covenants that a violation could occur. Now, I want to refer you to the second of the two blue bullet points. The guidance in general looks at a violation to the extent it's known, as we talked about, or certain to occur in the near future. And so that bolded word, certain to occur in the near future, what does that mean? And that's the thing I want to focus on here. So again, sitting there in April, no violation has occurred yet, but you're very worried that it will occur in July, August, somewhere down the road. You need to look at that and determine whether that near-term occurrence is probable or something less than probable. Maybe it's reasonably possible, but doesn't rise to that level of probability. Because if it's probable, then even though we're post-balance sheet, generally speaking, that long-term debt would get reclassed to current. And so if you remember, I had mentioned that the pandemic was a type 2 subsequent event, and you ordinarily don't adjust for those events. But this is a circumstance where you could see where, oh, wow, the effects of the pandemic have put me in a situation now where maybe I do have to reclass my debt. And now that becomes very difficult when you do your going concern analysis. All of a sudden, you've got debt that's been moved current, and it really just sort of cascades down from there. So I think what I'm recommending is that you be very thoughtful in your process and make sure at the end of the day that you do make that assessment. Maybe it's something less than probable. Maybe it's just reasonably possible. And by the way, reasonably possible is still in of itself a high threshold, right? Most accountants, auditors look at probability somewhere in that 80% level. So, you might look at reasonably possible as greater than 50%. But the key point, what you want to be able to defend, is that you've not reached the level of probability. And I think that if you are upfront and you do this analysis and bake it into your going concern analysis, present it to your auditor contemporaneously, with their audit, in my mind, you have a lot better chance of being able to get them comfortable as opposed to them bringing it up and then you're scrambling at the very end trying to decide, well, am I probable, am I not probable? So again, this is something that we've started to notice across our practice, and others are as well. All right, so that's probably the worst of the news, if there is any bad news per se, but I worry a little bit about this. It's somewhat of a sleeper issue. All right, a couple other things here. Now remember, we're still, for the most part, talking about your calendar year-end financial statements, recognizing most of you are private companies and are probably still getting ready, to file your financial statements with your lenders. So when we talk about valuation, impairment, debt compliance, all of these items, it's with this notion of a subsequent event. So you might be looking at receivables, you might be looking at intangibles, and you're saying to yourself, well, at 12/31/2019, there's no impairment to be recorded. However, I've already gotten a sense that my receivables are going to be harder to collect, therefore my allowance is likely to go higher. Those are disclosable items in your footnotes. Again, the estimates are based on facts and circumstances that were known or should have been known at that reporting date. So again, I always tell people, I wish they gave us a magic accounting 8-ball I could shake up and tell the future, because these are difficult disclosures to make, hard to tell what the future will hold. I think the other important item here is it's really not a one-size-fits-all. I mean, there are businesses that are not going to be as impacted as others. And so when you put your financial statements together, I think it's really important to understand that. And here's an example of a disclosure. It notes that March 11th date, and it alludes to the operations of the entity that may be significantly impacted by the pandemic, could result in material changes in the entities, and then describe, is it your receivable base? Is it your intangible assets? You're worried about the cash flows disintegrating and therefore triggering impairment. If it is impacting your ability to continue as a going concern, typically that's a separate footnote, as I'm sure you're aware. So, again, it's really not a one-size-fits-all. The more that you can tell your unique story, the better I think it is for everyone concerned. And what do I mean by that? Well, as you all realize, Auditor James lives in a world where, risk is all around. And I think we've seen over the years when financial conditions worsen, there tends to be a lot of litigation in our country, in our society. And so that increased risk, one of the ways that you offset that is just to be as transparent as you can be. And so if you're management and you're trying to just paint that picture as vividly as you can, that's the whole, hey, just be transparent, tell people what you know. And you're not responsible to predict with 100% accuracy. All you can do is disclose what you know at that point in time. And I think it will be helpful, to the extent investors, lenders, others that use these financial statements, start looking for a way to recoup losses. Hopefully that transparency, makes it that much harder for them to do that. So it isn't something that just benefits auditors. It really benefits everyone involved. And I think this is the type of event that for the most part, virtually everybody is going to be understanding, we're all living through. So I just want to encourage that. That's probably one of the other big takeaways. Now, why do I have to do this? Here's the literature that really governs this disclosure. This is under the guise of risks and uncertainties. As we talked about, the pandemic is a type 2 subsequent event. Ordinarily, that means that you're simply going to disclose what you believe the risk and uncertainty means to you and your business, as opposed to adjusting assets and liabilities. Again, I showed you the one exception that I worry about, but for the most part, again, at that 12/31 cutoff, it's a disclosure. And what we've seen is at a minimum, the existence of the pandemic, and again, that uncertainty of that potential impact on your future financial statements and operations, should be disclosed. Here's some more, I think, examples. And again, my point here more than anything else, you'll see in red, is to describe the specific impact here. A generic disclosure is better than no disclosure, but again, what you're really trying to do here is to mitigate your risk, the risk to the company that somebody feels you held back on something that would have made a difference in the use of the financial statements. Certainly the public companies have had this drilled into them by the SEC, but I think it's equally important to the private company base as well. As I said, we have a whole lot of attorneys in this country, and unfortunately, when things go wrong, we tend to see more of them. So there's a ton of this out there, by the way. I don't mean to imply that this particular disclosure is any better than anyone else, but again, it's one that you can use as a starting point, and to be overly redundant here, build it out. Where that red wording is your opportunity to make it very much specific to you. All right, and one more here. I won't belabor the point here. Just some different ways of saying what's going on, and again, tailoring it to your circumstances. All right, stop for just a moment here. What we're going to do next, talk a little bit about audit implications, because as much as we in the audit profession want to think we don't have impact, we know we do. And I want to make sure that to the extent that we can make you aware of what's likely to occur, it gives you a little bit of opportunity, hopefully, to deal with it, not come as a surprise. It may be that you wind up in a situation where the form of your audit report looks different. We talked about going concern, right? You should be aware that if there is a going concern, the auditor puts a very specific paragraph in their report to call that out. But sometimes it may not rise to that level. In other words, the auditor might get comfortable that there isn't substantial doubt. However, there's a significant amount of risk and uncertainty, and so they choose to describe that in an additional paragraph in their audit report. So again, it may look like the example that I've drawn up here for you, but just become aware of that. I would say, again, it just depends on facts and circumstances. Usually, going concern is what you're heightened, your sensitivity is very heightened there because it's calling in your very existence into question. So if you're not there, if you're something less than that, it still means there's something to be concerned about, but it's not as severe. So clearly there is a difference between the two, but even an emphasis of the matter, again, is going to draw attention to the facts and circumstances. And I don't really know how prevalent this will be. You know, we're still grinding through, you know, a lot of our private company work. The public company stuff got out there and filed before I think the profession as a whole really had a chance to wrap its mind around it. So in many instances, I think the private companies will be the ones that really bring this out in terms of practice. Subsequent events, we talked about this. You know, again, you're going to be asked to provide written representations, you know, what's occurred. So your auditor is certainly going to want to know what the pandemic has meant to you. It'll be an important part of their audit documentation, and it will be cross-referenced to the disclosure that you create. And I think at the end of the day, you know, it shouldn't be anything more, but just the facts as you know them to be. You know, as I mentioned that, you know, nobody should be expecting you to be able to predict the future. That's not what the standard says. You know, it's what's reasonable to have known at that point in time. So again, I don't want to, you know, if you get a firm that's really trying to get you to predict the future, then I guess maybe I'd say that's probably a little beyond what ordinarily you would be expected to do. And naturally, expect some representation. There definitely will be some things to think about as it relates to, you know, what auditors want to get comfortable with. And they'll ask, you know, certainly I no longer sign audit reports, but if I were signing audit reports, you know, I want my client to tell me in a formal representation, you know, that all of those known impacts have been disclosed. So you'll get undoubtedly a representation of that nature to contend with. And then the audit itself, you really think about this, you know, how do we do this remote? So there's a number of things with respect to our practice that, you know, we're trying to figure out, you know, inventory, you know, what does that mean? In our firm, we have to consult. You know, if there's a lot of inventory going on, we're going to want to consult. Same thing, if it's initial audit, you know, we've got requirements to figure out, are we doing all of the right things? You know, same thing in our SOC practice, you know, suspended operations, if your business has stopped, you know, those are all touch points for us to get our national office involved. And I would think that these would be very similar, you know, across, you know, whatever firm that you're utilizing, you know, be prepared for these type of things. So if you want to be proactive, that's always a good thing. Some of you are probably right in the middle of your audits, and so may have already resolved some of these issues, but, you know, again, they need to be addressed. And I think, again, a sense of reasonableness has to be brought to bear as well. Certainly that's my mindset as I think about our clients and our firm, and, you know, none of this was a client's doing whatsoever. It's an unfortunate fact. It's occurred, and, you know, we all have to get around it. Some lenders are granting extensions on the presentation of financial statements. We've seen some of that. Others are just insistent, you know, with 120 days and, you know, holding, you know, clients to that. So it just depends on your circumstances. All right. So let's think about what's going to happen next. You know, we've spent a fair amount of time talking largely about disclosure, because we've established that as it relates to the year end, the calendar year end, that March 11th date, that triggering event date, was a subsequent event. So we've kind of beat it into the ground a bit that you've got to tell your story. You have to evaluate, you know, what the risks and uncertainties are. You're going to have to think a lot about going concern and how does that impact and all that. But the real fun starts in the next quarter. And again, for private companies, the story will be told over a longer, you know, time frame, but then the impact will start to come home. For example, what about your intangible assets? Were there facts and circumstances that came from the pandemic that would diminish your cash flows? The same is true of goodwill, deferred tax assets, inventory, right of use assets, contract assets, any capitalized contract cost. All of those things now, will become fair game. If any of you have interim reporting requirements to your lenders, you'll want to think about that, because again, it's in that quarter that you'll really have to dig in. Now, if we go forward, say we go a full year before you had to report again, so you're only reporting once a year to your lender, I think more of this story will be known. Hopefully at some point we come out from underneath this, I don't know, depending on who you listen to, right? Business will go back to normal. It'll never go back to normal. Who can tell? But I do recognize for some of you that, are going to loop around, there'll be more time to look at these things, but certainly be aware of that. By the way, I put in the credit losses and financial assets. This is the CECL model now. For private companies, you're not going to have to deal with that for a couple of years. Even the smaller reporting entities don't have to deal with CECL either for a couple of years. But I think it's important, again, to start thinking a little bit about CECL. And even if you don't have a lot of financial instruments, most of you certainly have trade receivables, maybe some contract assets, and those will be evaluated under the CECL model. So what does that mean to you? Again, in today's world, we have this incurred loss model, which means that you look at your receivables and your contract assets and you ask a question that says, hey, is it probable that I have an impairment? And if it is probable, can I estimate what that impairment is? And a lot of times what we do is we age out our receivables, we look at our history and we say, well, on average, this is what happens when I get 120 days past due. Normally, 1% of these receivables are not collected, and you build up your reserve, okay? So CECL says, well, you've got to do this not as an expected loss, but over the life of the instrument. So over the life of the contract. So you've got to have some ability to look out to the future and figure out what could happen. Now, mostly if you think about receivables, they're short-term in nature. If you're not granting payment terms that exceed 12 months, it may not be that difficult for you to sustain what you've been doing. In fact, one of the examples in the standard, ASC 326, is an aging approach. So that's still allowable. However, under the CECL model, you're expected to have some kind of credit loss, even if that loss is thought to be remote. Okay, so again, this will take a little bit of time to work out, but I do want to give you a heads up on it. It's going to be, I think, somewhat of a challenge for the private companies in particular. If we think about inventory, a lot of this has to do with the supply process. What's happened here? How much do we have in terms of distribution challenges? What about our fixed overhead calculation? What about plant shutdowns? What about impact to production quotas? There's a lot of issues that go with inventory, and you'll need to think that through. I think revenue recognition in a similar vein. What about the ability now to assert it's probable that you're going to collect? Remember, 606 requires you to assess the probability of collection on the front end. You have to be able to do that up front. And if you're not able to do that, then you fall out of 606. All right, you wouldn't be dealing with 606. You're in another place in the literature and you're probably not recording revenue. So you'll have to think through that a little bit. Also, what about sales returns, rebates? Are those going to go up now under the, conditions that we're dealing with now? And that's entirely possible as well. I think one of the items that is certainly going to be looked at is impairment. So if you don't have any impairment, wait a minute, triggering events and early warning disclosures may be necessary. And I would tell you that for most firms, they're going to look at that March 11th date when the WHO declared this worldwide pandemic. They're going to look at that as a triggering event and ask the question out loud, do you have impairment? Now, if you're a business that's done well, you've sustained your revenue base, your cash flows haven't really been impacted all that much, you may be fine. Just because there's a triggering event does not mean there's impairment, but you should be prepared. You should be prepared to go through that analysis. I think it would be unlikely that your auditor is going to look at this and say, well, it's okay for you. I think everyone's going to have to contend with this pandemic, becoming a triggering event. Same thing with concentrations. There may be more relevant disclosures pertaining to your labor than there have been in the past. Maybe your sources of supply now are impacted. Are some of your suppliers unable to fulfill their contracts? And does that put pressure on you? Does that now mean you've got more concentration in terms of how you obtain the necessary inputs for your business? Same with your customers. Does it cause any concentration in your customer base? And again, certain investments that you might have, if you have an investment in a company that's significantly impacted, travel and oil are just a couple examples. And, a lot of hospitality are also very much impacted. The restaurants have had to change their business model, can't go into a restaurant anymore, have to deal with the, take the food and go. So what does that mean? And then also credit risk with customers. Are they the same as they were before? A lot of this is going to cause complication. And to me, one of the things that's hard to predict is, let's say we loop around a year from now. We're sitting here in the spring of 2021. You're working on your 2020 financial statements. Does all of this now go away if the economy manages to snap back? And the answer to that is probably no. There will be this notion of what happened in this 2020 timeframe. Was there in fact impairment? It'll be interesting, and I'm not sure I know the answer to this, as to how much hindsight firms are going to be willing to rely on. If your business really did snap all the way back and there isn't any meaningful, degradation in your cash flows and your customer base, does that mean everything was okay in March and April of 2020? It'll be interesting to see how that's played out. Maybe you have stock compensation and equity awards that have to be modified now because valuations are dropping. And if the options now are thought to be deeply out of the money, they're not very valuable as incentives any longer. So maybe some of that needs to be dealt with. And then again, as we've talked about, estimates, how do you make these estimates, with all of this near-term uncertainty will be particularly important as well. All right, so we've got some questions. We've made some pretty good time here. I wasn't really sure how long this presentation would go. It's kind of tough to do it. I do want to touch on a couple of other thoughts though here. Roy, hopefully you've got some questions here. One thing to also be aware of, there have been a number of what I'll say sessions regarding rent. So sometimes landlords have understood this pandemic is really, really hard on businesses and concessions have been made. Sometimes it is just the rent itself is deferred. In some instances, landlords have outright forgiven the rents. And so these are good things, but what's the accounting ramifications of that? And so to the extent that you have a concession that is based on an enforceable right, then that doesn't trigger a lease modification. Now, a lot of times when you get into your rental agreements, you'll see a clause in there, and it's the force majeure, which I think we're all familiar with, right? The proverbial act of God. Something occurs that's out of your control. And so if that clause exists in your contract, you would argue that that concession was based on an enforceable right and therefore not a lease modification. And if you say, well, James, why do I care? What's the big deal about a lease modification? It's more work, right? The question under the lease modification guidance is whether or not you have created a new lease as opposed to continuing on with the existing lease. And if you've got a lot of those, those are difficult things to deal with. So I think there's some concern about that. However, I think the good news here is that the FASB's come out and authored a Q&A. In that Q&A, what they basically said is, look, we're going to allow you to treat that these concessions, as long as they relate directly to COVID-19 and they don't appreciably change the lease payments except in one direction, meaning the lease payments could be less, but that your landlord doesn't defer and then ultimately tack on a higher price on the back end. Long as those conditions exist, then we'll treat this as though you had an enforceable right. And I think what that does, it removes this notion of what does force majeure really mean. It also allows people to go forward without having to deal with, do I not have an enforceable right? And I think it's a good thing for sure. Then you really effectively have a couple of decisions to make. You can continue to account for the lease as if no deferral had been provided. So you just record that payable and your lessor records the receivable for the amounts that were deferred. Or you could account for the deferred payments as variable lease payments in the way the literature deals with that. By the way, this is true under 840 or 842. And also, as I understand it, the SEC Corp Fin folks have stated their agreement with what FASB has done. So I think there's some good stuff there across the board. Something else I want to talk a little bit about, and it may not be as critical for the private company crowd, but certainly it's a consideration. And that is your internal control. So if you think about it, internal controls may be very different. With so many of us working from home, what does that mean to your control structure? Now if you were the controller of a private company and periodically you worked from home such that you had security built up already, and really your job wasn't very much different, whether you were sitting in the office or sitting at home, there may be a good argument that says, well, there's no impact on control. But let's say you're a company that has never really, allowed for the remote working environment, and this was something that you all had to figure out on the fly. That could be a very different story. You may well have changes in your internal controls. The reason I bring that up is because for auditing purposes, we have to be able to rely on controls during the entire year to the extent we are going to rely on them to reduce our testing. So might there now be 2 control environments that we have to deal with? And there may be expectation that you demonstrate that you still had controls, during this quarantine period. So it's definitely an area to think about and to talk to your auditor about what does it mean? How comfortable are you going to be? What type of documentation are you going to expect from me? And even yourselves, thinking through segregation of duties and all of those things that are important for private businesses. So somewhat of a sleeper issue, but nevertheless, I think internal control also plays a big part on it. So Robin, I wonder if we have any questions. It might be a good time to, I'm hoping that there are some questions I can give you, some feedback in terms of what we're seeing, if anyone has any.
So James, if you go to your bottom, there's a Q&A icon. If you click on that, there is a question in there.
Q&A, Oh, wait, is that it? No, that's the search thing. Do I have to get out of the main thing, the main Zoom?
No, you can close your PowerPoint if you're done with it.
Okay, so.
Or I can allow Paul's the one who asked the question. I can make him live and he can talk.
That'd be even better. But I'd love to hear from someone. I feel like I've been doing
Okay, Paul.
Yeah.
Can you hear me?
I
can
can.
hear you.
Excellent. Hey, if you are the recipient of one of the PPP loans, that obviously I'm sure you're aware carries a 1% interest rate, shouldn't need to be paid back. However, if it is used for qualifying expenses, i.e. payroll-related expenses, as well as some rent, it will be forgiven as a grant.
Yes.
How are you seeing these recorded? I'm thinking it would be recorded as a a debit to cash and a credit to either a liability until such time it's determined that it is going to be forgiven, or if it's highly probable that it's going to be forgiven because that's all you're going to use it for. Can you set it up as I'm thinking below the line as some sort of another income or expense reduction, since it's not from operations? Your thoughts?
No, that's a really good question. It's an area that at the moment, everyone is trying to wrap their minds around it, because what's interesting, when you go into the codification US GAAP, there isn't anything that specifically deals with what we'll call, for lack of a better term, what could be a government grant. And so interestingly enough, over the years, most of the big firms have leaned on IFRS, which does have a government grant kind of mindset. And so the reason why I think in some ways that's good, because it gets you a little bit out of that mindset of, well, I essentially have another form of borrowing that I may have to pay back. Now, having said that, I think you made a really good point about probability, right? Because you have to look at those conditions that are attached to it and make sure at the end of the day that you don't believe it's probable that you are going to have to pay it back. Because if you do, if you're not at that level of probability, pretty high belief that I'm not going to have to pay this back, then of course it should get liability treatment.
Right.
On the other hand, like I said, I think a lot of firms are stepping through various models and trying to figure out where they land. I can tell you we're kind of leaning, and again, I'm getting way ahead of myself here, but all in the spirit of trying to help people. I think we're taking a really hard look at the notion of a government grant. There's a couple of other mindsets. Some would be, if you can believe this, looking at the variable consideration model under topic 606 and trying to slot it there. I don't really care for that answer. I don't think it makes a whole lot of sense, but some firms do. So what we believe is going to happen, Paul, is that the FASB is going to give us the answer. And I am aware of instances where firms have used, public company firms now have gotten these loans, if you will, and treated them, analogized to IFRS and this grant standard, and the SEC, near as we can tell, has left it alone. Now, I owe you that exact standard. I will send that to Robin because I don't, darn it, I forgot to print that out. Mastered the codification, but not so much IFRS. I think that's where it's headed. Now, in terms of the geography, that's going to be another, I think, facts and circumstances, right? Because, you talked about, well, could I put that credit through other income? Some like that answer. Other people say this, well, if what you utilized that for was to effectively pay your employees, wouldn't that credit be better placed against those expenses? And so at the end of the day, that's the better matching. So I think there is a lot of uncertainty, but Paul, everything that you said is very logical. Hold on, I think you're going to get a very specific answer. My guess is in the next week, you'll see a lot more clarity on that. But you're definitely thinking similarly to most of the firms and what their thoughts are.
Great, thank you.
I didn't have it. I don't see any more questions. Does anybody have any other questions?
Well, I can do two things, Robin. One, I will send over the slide deck for everybody. And then also I'll put the reference point to that IFRS standard. And then a couple of other things, some links to a couple other things that I believe will be helpful to you. There really are a lot of publications out there. It's remarkable how much commotion this has stirred up. And I think in a lot of ways, it's frustrating because it's this offer to try to predict the future, right? And that's what I try to tell our clients as much as possible. Protect yourself. You publish your notes to the financial statements. Tell people what you know. Tell them what you think is going to occur to the best of your knowledge. Use all the qualifiers you want. And then if bad things happen, you've given yourself a little bit of insulation for criticism that you held back on them. Once we get into 2020's financial reporting, then there'll be much more specific gap to apply. And again, I think that you should expect some further clarity, not only accounting for the loans, but also we talked about this notion of hindsight. I think that's a question that the profession is going to have to come to grips with. Do we force private company clients into doing analysis when things sort of right the ship at the end of the day? I've not heard, too much on that yet, but I suspect that we will. Certainly at our firm, it's something I want to push on because again, we're all going to face challenges in terms of our personnel. And I worry a little bit about that, right? This disruption makes it so much harder for all of us to keep qualified people. And I'm worried that'll be one of the fallouts from all of this, that it'll be just difficult for, people to sustain. And as I often say to all of you, I know you're not sitting on accounting departments loaded with staff. That all went away 2008, 2009 during the financial crisis. And for the most part, didn't get built back up. So heaven forbid that, we have to go leaner still. So my hope is that we can give you exactly what you need to know. This is what we have to have and not leave it so open-ended that you do a bunch of things that at the end of the day weren't necessary. But it's certainly going to be a work in process. And, I'll just commit on our end, we'll do the best to communicate what that is going to be from our firm's perspective. Robin, if anyone has any questions, if things come up, don't hesitate, send me an email. I'm more than happy to help. If you're an MHM client, I can certainly help. If you're not, don't let that dissuade you. If I can help you in any way, I'm always happy to. And, naturally can't get in between you and your current auditor, but I can certainly point you to some things that might help you in terms of being prepared to go talk to your auditor. I think at this point we have to look out for each other. This is an unfortunate thing that none of us, want to have to be dealing with. So I feel like we should not be adversarial, and auditors need to keep that in mind and be doing what they can, to assist clients through it. Sure, we have to be independent and all of that, but if you think I can help you, just send me an email and I'm happy to do that.
Thank you, James. Can you include, maybe you can add your email into the PowerPoint presentation so when we send it out, everybody will have it?
Well, absolutely, Robin. I'm going to send it directly to you with that and a couple of other things to share. And like I said, I really just coming out to the Phoenix area and meeting with all of you. Fingers crossed that next year I will be with you in person. And I I wish everybody nothing but safety and do well this year. Let's put this thing back together, right?
Thank you, James.
You're welcome. Bye-bye now.
Bye.